All right, in this video, let's talk about the real estate accountant. So my accountant that I found in my local hometown does a great job helping me with taxes every year in terms of my businesses, my real estate investments, and my personal income from different jobs that I work. So with that being said, on the real estate investing side, having a good accountant that knows real estate investing is key to saving you money on taxes. Real estate investing has many benefits for taxes given to you by the government. Now, I am going to put a disclaimer up that I'm not a certified accountant. I'm not a financial advisor that's licensed. So anything in this video, you should not take as truthful fact. It's educational content only. Consult your own attorney, financial advisor, and accountant for more clarity on these topics. But with that being said, real estate accounting, you can do things in real estate like write off different expenses as business expenses that you normally wouldn't be able to write off as a typical everyday person working a job. So what do I mean by this? First off, if you have certain meals that you're eating out while you're working one day. So let's say you go to your property to do some work and you need to take a lunch break and go eat some lunch and come back. Or you're going to go meet somebody for lunch to talk real estate investing, like maybe a lender or one of your business partners or one of your contractors that you're interviewing to come do some work at one of your properties. So sometimes you can write off these expenses for lunches as a business expense. So again, this can save you some money on your taxes, deducting meals as a business expense. You also can deduct different expenses related to your vehicle. So gas mileage, depreciation on your car, different expenses related to your car like oil changes, repairs, different things. Since this is a business vehicle used for business purposes, your accountant can make sure to classify your business vehicle as a business vehicle. So it starts off as a personal vehicle until they register it as a business vehicle so that they can count some of the deductions towards the vehicle as business expenses. In addition to food and vehicle expenses, they can also deduct other things related to the property itself. So when doing taxes, make sure you're keeping track of all the different expenses related to that property. So anything like utility bills, repairs that you have done, if you've got, property insurance, your property taxes, your mortgage interest that you're paying to the lender. These are all different expenses that you want to make sure you're subtracting against your rental income or against your fix and flip profit so that it reduces that profit down to the true net income. Because if you factor in the fact that you made that money, but you also had those expenses, your true net income is actually less, and that's the net income you should be paying taxes on. You shouldn't pay taxes on the gross income since you didn't factor in all those expenses. You shouldn't be paying taxes on gross income. It should be on your net income. So make sure you utilize as many expenses that you can get your hands on using your accountant's advice and using their experience so that you can knock down that gross income to a smaller net income that then you'll charge that tax rate against. Now, one of the things to note with your real estate accountant is you want to make sure that their fee is reasonable. Some real estate accountants will try to charge a percentage of the assets that they're doing tax returns on. So if you've got lots of properties, they may be trying to hit you with a fee that's a percentage of all the different properties or the income that you're making from those properties. This is kind of a rare structure, but it is out there and you got to be aware of it. Instead, I prefer to use fees that are flat fees charged by real estate accountants. So you know what the fee is ahead of time and you're not caught off guard. And as you grow your business and you do more business and make more money, the fee to your accountant doesn't keep increasing in proportion with your business growing. You want to just kind of keep that accountant at that same flat fee over time so that they're not digging more into your pockets with their expenses. So with that being said, flat fees typically get charged based on how much paperwork there is. So if you're filing a Schedule E for rental property goes on Schedule E's. Now, if I've got 2 rental properties, I'm going to have to fill out 2 different Schedule E's, one for each property. Again, it's just a tax document that summarizes how much income I made, what my different expenses were, and what my net income was. So if I've got 10 different rental properties, you'll have to fill out 10 different Schedule E's. Now, if you have more properties and more Schedule E's, your real estate accountant might charge you a certain fee per document. So the more documents you end up adding to your tax return, the more your tax bill could be to your accountant. So keep that in mind, but still this ends up being a cheaper structure than paying as a percentage of income or a percentage of your assets that you have. This is kind of like the reverse side, where when you get into the world of investing in stocks, most financial managers try to charge a percentage. So as you have $1 million portfolio in the stock market and it goes up to $2 million, now that financial advisor is getting that same percentage, but now they're making it on $2 million. So their fee is going up over time with your portfolio. And this charges you lots of extra money that you shouldn't have to pay in fees. So I prefer sticking with flat fee structures when I'm looking at financial advisors for stocks. Same way with real estate accountants, I look for flat fee structures so that I can make sure that I'm only paying, based on certain paperwork being filed. I'm not paying as a percentage of my assets or of my income. With that being said, real estate accounting is pretty straightforward. You're going to total up the income you earn from your properties. You're going to look for any sort of business expenses you can legally write off as business expenses. Now, this net income will get passed on to your personal tax return if you're an LLC or a sole proprietor. If you have a business corporation set up like an S Corp or a C Corp, it's going to be taxed differently. So again, having an experienced accountant who knows how to handle real estate accounting is going to be key and beneficial, as they can check for any sort of not loopholes, but basically permissions, grants, legal deductions that the government is allowing you to take. So they're going to have knowledge of things that you might not even think of, and they're going to find extra ways to save you some extra money through your real estate investment holdings when it comes tax season. So hiring an accountant to do your taxes for you may end up costing you a little bit of money rather than you doing it yourself, but you may actually save more because they have better knowledge of the tax codes, so they can end up saving you more money to kind of cancel out the fee that they're charging you. So you may come ahead still in the long run, and it's just more of a comfort thing. Having an accountant do this stuff for me, it saves me time and it gives me peace of mind that I've got a professional handling it, because the last thing you want to do is file your taxes incorrectly and have the government coming after you with a penalty, making you pay extra penalty fees for doing your taxes wrong. So real estate accountants, you can find them by getting reviews, referrals from local people in your market, looking online at reviews, and even stopping into different offices in your city to ask if they're taking new clients, what their experience is with real estate, and doing some sort of interview process to make sure you vet them out and you feel like they're going to be a good fit.